As of the close of regular trading on Friday, May 26, 2026, at 4 p.m. Eastern Time, Nokia stock closed at exactly $14.18 per share, marking a significant intraday gain of 10.54% on the New York Stock Exchange. This sharp upward movement represents one of the most volatile and heavily traded sessions the telecom hardware giant has seen in recent memory, with volume metrics exploding past normal daily averages. For years, ordinary market participants looked at this ticker as a forgotten relic of the early cellular days, a slow-moving utility proxy that sat dead in the water while newer tech enterprises captured the spotlight. Yet, looking closely at the massive volume behind this double-digit single-day surge reveals an entirely different picture. The underlying reality is that major capital allocators are aggressively accumulating shares because Nokia is quietly becoming a core structural provider for the global infrastructure boom. While retail traders were busy hunting for high-flying software names, large-scale financial entities noticed a dramatic pivot in the company's order book, positioning it perfectly to capture massive spending allocations that are currently reshaping the global enterprise landscape. The overwhelming market consensus surrounding Nokia stock has long been anchored in skepticism. The general belief suggests that legacy networking hardware is a commoditized, low-margin business plagued by fierce price wars, slow deployment cycles, and an exhaustant dependence on telecom capital expenditure cycles that have largely cooled off. Investors frequently assumed that once the global 5G rollout peaked, infrastructure providers would face an extended period of structural stagnation. This perspective is precisely why the stock spent years languishing in single digits. However, the expectation of terminal deceleration completely misses the reality of how global networks are being reorganized. The massive influx of artificial intelligence processing workloads has created an unprecedented data traffic bottleneck, not just inside the data centers themselves, but in the optical pipelines that connect them. This is where the old narrative falls apart completely. Nokia is seeing an unprecedented acceleration in demand from high-capacity cloud providers, booking over €1 billion in pure data center and cloud infrastructure orders in the first quarter of 2026 alone. The market expected a dying telecom business, but the reality reveals a highly sophisticated optical and internet protocol networking powerhouse that is actively expanding its footprint where data velocity matters most. When you look at recent trading behavior, the price action tells a story of aggressive accumulation and structural re-rating. The 10.5% surge to $14.18 did not happen in a vacuum. It was sparked by tangible corporate execution, specifically the official launch of Nokia's AI Network Innovation Lab in California. Wall Street reacted instantly because this initiative transitions their engineering capabilities from abstract promises into functional, high-margin deployments. Major brokerages spent the session aggressively revising their near-term targets upward, pointing directly at the massive expansion in data center component spending. This momentum has been building throughout the month, especially after competitor updates from firms like Cisco highlighted a 25% surge in enterprise networking demand. Institutional investors utilizing sophisticated platforms, from high-end institutional pipelines to retail platforms like Interactive Brokers, have been repositioning into networking hardware as valuation metrics in software segments become increasingly stretched. If you analyze the broader sector momentum, capital is rotating out of speculative tech and directly into physical infrastructure plays that possess fortress balance sheets and real cash generation. The options market confirms this structural shift, with open interest for near-the-money calls experiencing an unprecedented spike during recent sessions. Traders are clearly betting on sustained upward momentum leading into the company's mid-summer financial reporting cycle. The daily swings we are observing reflect a fundamental tug-of-war between short-term profit-takers who remember the stock's sluggish past and long-term institutional allocators who recognize the structural undervaluation. If you look at major funds, organizations like FMR have maintained solid single-digit stakes in the enterprise, and recent filings indicate that accumulation is outstripping liquidation across major asset managers. Macroeconomic pressures, particularly higher for longer interest rate environments, have forced a total reassessment of balance sheet health across the technology landscape. In this environment, Nokia shines because of its incredibly conservative debt-to-equity ratio of just 0.16. While highly leveraged growth enterprises struggle to service their obligations, Nokia sits on a net cash buffer of €3.8 billion, allowing it to aggressively fund research and development or execute strategic acquisitions without relying on expensive debt markets. Take a second to drop a comment below with exactly how many shares of Nokia stock you are currently holding in your individual brokerage account, or let me know if you are completely avoiding the telecom sector right now. To truly understand why the recent financials caught the street off guard, we have to look directly at the margin expansion detailed in their opening quarter report for 2026. The company delivered a solid 4% increase in comparable net sales, but the real breakthrough was in its profitability metrics. Comparable gross margins expanded by a massive 320 basis points to 45.5%, while operating margins climbed 200 basis points to reach 6.2%. This margin expansion is driven entirely by a shift in product mix. The network infrastructure division grew 6%, led by a blistering 20% growth rate in optical networks alone. This specific segment is highly profitable compared to traditional mobile access equipment. Management was so confident in this trajectory that they officially raised their full-year guidance for the combined IP and optical networking units, forecasting an 18 to 20% growth rate for the entire year. This unexpected operating leverage is why the trailing price-to-earnings ratio, which currently sits near 78 times due to historical restructuring costs and older legacy drag, is viewed by forward-looking allocators as a backward-looking metric that obscures the company's true earning power over the next 24 months. To put this structural pivot into perspective, it helps to understand exactly what Nokia does today and how its business model actually functions. The modern corporation operates through distinct business segments: network infrastructure, mobile networks, cloud and network services, and Nokia Technologies. The legacy mobile networks division, which creates the physical base stations, antennas, and radio access networks for mobile operators, used to be the primary engine of the company. Today, however, the real growth engine is network infrastructure, which designs the ultra-high-speed optical routing systems, subsea cables, and fixed fiber networks that form the actual backbone of the global internet. Their revenue model is built on high-value hardware sales paired with long-term software licensing and maintenance contracts, creating a predictable recurring revenue stream once an enterprise or government integrates their architecture. Additionally, their Nokia Technologies division acts as a pure intellectual property powerhouse, licensing a vast catalog of essential cellular patents to smartphone manufacturers, automotive companies, and consumer electronics brands, pulling in pure high-margin royalty revenue that requires virtually zero operational overhead to maintain. This current positioning is a far cry from the historical narrative that most casual investors associate with the brand. Everyone remembers Nokia as the dominant global leader in mobile handsets during the late 90s and early 2000s, an enterprise that completely collapsed when it failed to adapt to the smartphone transition, eventually selling its disastrous mobile device division to Microsoft. What followed was an ungrueling decade of corporate reinvention, highlighted by the massive acquisition of Alcatel-Lucent, which completely shifted the company's focus away from consumer hardware and entirely toward carrier-grade telecommunications infrastructure. They spent years cutting costs, streaming manufacturing, and trying to win back market share from global competitors. Past performance was characterized by choppy revenue, constant restructuring charges, and geographic headwinds, particularly in North America, where major telecom operators frequently shifted their capital spending plans. For years, the financial community viewed the stock as an absolute value trap, a company that could generate decent free cash flow but lacked the secular catalysts necessary to drive sustained capital appreciation. That historical drag is exactly why the current transformation creates such a compelling setup for modern online investing strategies. Whether an investor is utilizing automated wealth features like Schwab Intelligent Portfolios, managing their own capital through self-investing on the Robinhood app, or tracking long-term positions inside Fidelity IRAs, the structural changes at Nokia demand attention. The company's recent strategic moves extend far beyond standard product updates. They have successfully locked in an expanding asset base by aligning with the absolute leaders of the current infrastructure build-out. Their partnership with NVIDIA to develop advanced GPU-powered radio access networks is already showing functional real-world validation, successfully proving that commercial artificial intelligence workloads and standard telecom carrier traffic can run simultaneously on the exact same shared physical servers. This allows network operators to monetize their physical footprints in ways that were technically impossible just 24 months ago, opening up entirely new enterprise business models for massive global telecom providers. Furthermore, the geopolitical landscape has completely shifted the competitive dynamics of the hardware industry, creating a massive regulatory tailwind for Western infrastructure firms. Nokia has aggressively capitalized on this by securing a massive $4 billion investment commitment focused on expanding its advanced research and manufacturing footprint inside the United States, which directly complements their recent $2.3 billion acquisition of optical networking specialist Infinera. By cementing these domestic manufacturing capabilities, they have made themselves the premier choice for mission-critical government architecture. This is already paying off through high-profile collaborations with major defense contractors like Lockheed Martin to deliver secure, modular 5G solutions tailored specifically for the Department of Defense. This allows tactical military platforms to seamlessly leverage commercial infrastructure while maintaining absolute cryptographic security in the field. This type of high-margin, long-term sovereign enterprise business provides a massive buffer against any cyclical downturn in consumer-facing telecom markets.
Looking strictly at the forward-looking scenarios, the path ahead for Nokia stock is defined by clear catalysts but balanced by real operational risks. In the most optimistic bull case, the demand for optical network upgrades from massive cloud providers continues to accelerate at its current 49% year-over-year clip, turning the high-margin network infrastructure division into the undisputed core of the entire corporation. As these shipments scale, the massive operating leverage inherent in their manufacturing facilities should drive a permanent expansion in corporate operating margins, leading to a massive re-rating of the stock as it transitions from being valued as a legacy telecom cyclical to a vital enterprise tech provider. Conversely, the bear case cannot be ignored. The mobile networks division remains highly dependent on traditional carrier spending, and if global telecom operators continue to pull back on routine capital allocations due to economic uncertainty, that drag could easily blunt the explosive growth seen in the optical segment. Additionally, executing massive integrations like the Infinera acquisition always carries structural execution risk, and any delays in achieving projected cost synergies could temporarily crimp free cash flow generation. When you synthesize the entire picture, the contrast between investor expectation and underlying reality becomes undeniably stark. The market narrative expected a stagnant, low-margin hardware vendor trapped in the shadow of a post-5G slowdown, but the reality reveals an enterprise that has successfully repositioned its balance sheet, its technology, and its strategic partnerships to sit directly in the path of the largest enterprise spending cycle of the decade. With an upcoming financial report scheduled for July 23rd, where consensus estimates are already projecting a massive 40% year-over-year jump in quarterly earnings per share, the financial